It's the world's largest bank by market cap and run by one of crypto's most tireless haters. But while Jamie Dimon trash talks Bitcoin in the streets,
Bitcoin itself is a hyped up fraud. It's a pet rocket.
You're back to that?
Yeah,
Really?
Of course, yeah.
JP Morgan is offering clients crypto in the sheets. So, what's up with that? And is it bullish, bearish, or no big deal? Today we investigate the parasitic relationship between America's biggest megabank and crypto. My name is Nick, and you're watching the Coin Bureau. In crypto's new era of institutional adoption, ETFs, and presidential meme coins, you have to hand it to JP Morgan CEO Jamie Dimon for not folding like so many of his Wall Street colleagues have. Even as his bank has embraced crypto product offerings, Dimon has remained a perma-bear, and that takes real conviction. Dimon Hands, if you will. As one of crypto's most prolific haters, Dimon's greatest hits stretch back to at least September 2017. Back then, an unprecedented wave of retail FOMO had driven BTC up to almost $5,000, and Dimon was disgusted. At an investor conference that month, he famously called Bitcoin, quote, a fraud, and declared it, quote, worse than tulip bulbs, which, let's be honest, is kind of funny. He wasn't joking around, though, as he also threatened to fire any JP Morgan trader dealing in Bitcoin, quote, in a second, not only because it was against company rules, but because, quote, they're stupid. Of course, that was about $100,000 ago now, so we suspect any JP Morgan traders caught longing Bitcoin in 2017 won't have too many regrets. At the time, Bitcoin was still years away from attaining macro asset status, let alone being embraced by many of Dimon's colleagues on Wall Street. For TradFi institutions, it was more of an oddity rather than an opportunity. But since JP Morgan is the world's largest bank by market cap, it's probably safe to call Dimon a key opinion leader. His coming out so strongly against Bitcoin in 2017 will have helped set the tone for serious TradFi institutions. Bitcoin was illegitimate, professionally untouchable, and intellectually bankrupt. However, even as he was condemning Bitcoin, Dimon was already drawing a distinction that would become the central tenet of JP Morgan's public-facing strategy. Just a month after his fraud comment, he clarified his position. Quote, I could care less about Bitcoin, he said, but immediately added, quote, blockchain is a technology which is a good technology. We actually use it. God bless the blockchain. Charming. Without Bitcoin, there would be no blockchain, but never mind, I suppose. Dimon's praise of blockchain seems a bit disingenuous, since he was openly casting doubt on the maximum supply of Bitcoin as recently as January 2024. At the World Economic Forum in Davos that month, Dimon said, quote, how the hell do you know it's going to stop at 21? Bitcoin is the largest and most secure blockchain in the world, and to suggest the maximum supply of BTC could simply be raised one day suggests either a very poor understanding of blockchain, or worse, a cynical instinct to spread FUD with no regard for whether it has any factual basis or not. At any rate, Dimon has worked hard to pave the way for old guard institutions like JP Morgan to position themselves as pro-innovation by co-opting blockchain while, in fact, opposing its raison d'etre and denigrating its permissionless public manifestation in Bitcoin. This God bless the blockchain pivot was the land grab that gave us TradFi's world of distributed ledger technology and digital assets, scrubbed clean of any trace of the C word. It conveniently allowed JP Morgan to avoid being accused of hypocrisy when it launched its first blockchain product, the Interbank Information Network, known now as Connexus Link, that same month. As the crypto market matured and endured cycle after cycle, Dimon adopted new analogies but remained dismissive. At the World Economic Forum in Davos and in US Senate hearings, he repeatedly called Bitcoin, quote, a pet rock because, in his view, it, quote, does nothing, except for appreciating from $0 to over $100,000 per unit, outperforming every other major asset class over the last 15 years, we might add. But who's counting? Dimon's rock quip is like a meaner version of Warren Buffett's criticism of gold, which he has always maintained is, quote, neither of much use nor procreative. Gold significantly outperformed the S&P 500 and Berkshire Hathaway over the last 25 years, but it has of course failed to outperform BTC since 2009 when the first coin was mined. I guess that means we're on the same page with Mr. Buffett. Gold is totally useless now. And by the way, guys, if you're planning on buying the best performing asset over the past 15 years, then you have to check out the Coin Bureau deals page in the description. Over there, you'll find sign-up bonuses of up to $100,000 on the best crypto exchanges. You'll also get 50% trading fee discounts and 75% cashbacks on deposits. These deals won't be around for long, so take advantage of them while you still can by hitting that link down in the description or scanning this QR code right over here. Back to the video. Unfortunately, the pet rock thing is Dimon when he's feeling generous, because as Bitcoin went from strength to strength, he only intensified his association of crypto with criminality. He told a congressional hearing in September 2022 that, quote, crypto tokens, which you call currency, like Bitcoin, they are decentralized Ponzi schemes, and the notion that it's good for anybody is unbelievable. He went on to link crypto to ransomware, money laundering, human trafficking, and theft, and emphasized that it is, quote, dangerous. And this was a significant escalation for Dimon, who had previously said that he regretted describing Bitcoin as a fraud. Dismissing crypto as being somehow fraudulent, a pet rock, and for stupid people is one thing, but telling the US Congress that it is dangerous and utterly criminal is quite another. And this was a clear attempt to influence government policy to take a hardline stance against crypto. And as if Dimon hadn't made his recommendation clear enough, he returned to Washington in 2023 to spell it out in black and white. He testified before a Senate hearing that he has, quote, always been deeply opposed to crypto, Bitcoin, etc., and agreed with crypto naysayer Senator Elizabeth Warren that, quote, the only true use case for it is criminals, drug traffickers, money launderers, and tax avoidance. Never one to waste an opportunity, Dimon added, quote, if I was the government, I'd close it down. We can only wonder how many people in that room were aware of the extraordinary list of crimes and criminal allegations against JP Morgan, for which the bank has paid around $39 billion in fines, penalties, and settlements under Dimon's leadership, like the $365 million in settlements in 2023 over allegations that it knowingly enabled and financially benefited from Jeffrey Epstein's clandestine operations. Or how about the $13 billion fine for the bank's role in the Great Financial Crisis of 2008? Or the $2.6 billion fine for the bank's role in Bernie Madoff's Ponzi scheme? The $920 million fine for the alleged manipulations of metals futures markets between 2008 and 2016? And the $55 million JP Morgan had to pay in 2017 over allegations it was charging Black and Latino borrowers higher interest rates on auto loans? Or the $200 million in fines after employees, including senior executives, were found to be systematically violating securities laws by conducting business without preserving records, despite repeated warnings between 2021 and 2024. Or that cargo ship reportedly owned by a fund run by JP Morgan that was seized by US Customs after getting caught trying to smuggle 20 tons of cocaine worth $1.3 billion into the US in 2019. It's a good thing that all of this is chump change to JP Morgan, as it can easily pay to settle any lawsuit it needs to without ever having to admit any wrongdoing. If it didn't have such deep pockets, the government might think about closing it down. Just kidding, that would never happen. The rabbit hole of crime at JP Morgan runs extremely deep, but crypto is the real danger here, so never mind. Dimon's framing of crypto as a matter of crime and national security was clearly intended to resonate with lawmakers and regulators focused on anti-money laundering and combating terrorist financing, and of course provide Wall Street the stamp of approval for a crypto crackdown. And crackdown the government did through the long arm of the SEC during the Biden administration. It feels like several lifetimes ago now, but it was only around 8 months ago that the US government was waging an all-out war on crypto via the agency, whose behavior suggested a government that wanted to close down crypto one way or another. However, following the massive success of spot Bitcoin ETFs and mounting pressure from clients and competitors, JP Morgan capitulated and announced it would grant clients access to purchase Bitcoin. So, what did it mean for Dimon? Did he, like Larry Fink and so many others on Wall Street, acknowledge that his views had changed? Well, not really, no. After years of trying to pin the word crime on Bitcoin, in May 2025, Dimon adopted a new analogy to justify JP Morgan announcing that it will allow clients to buy Bitcoin ETFs. While reiterating that he is, quote, not a fan of Bitcoin, Dimon added, quote, I don't think you should smoke, but I defend your right to smoke. I defend your right to buy Bitcoin. Go at it. This shrewd analogy slaps a warning label on Bitcoin that allows JP Morgan to meet demand and avoid losing business to competitors, while sidestepping accusations of hypocrisy and signaling that Jamie Dimon is still the responsible adult in a chaotic industry. It's not clear who this signal is for anymore. Since Dimon's core audience of Warrenite anti-crypto regulators, lawmakers, and shareholders has all been eviscerated by the second Trump administration. Ideally, for JP Morgan, the US would have continued down the path it was on under the Biden administration, when the SEC was containing crypto with weaponized regulatory uncertainty, aggressive litigation, and hefty penalties for crypto founders. However, the exact opposite happened as Trump returned to office and effectively blessed institutional crypto involvement. And this forced the bank's hand in the public-facing ETF market, as competitors like Morgan Stanley and Goldman Sachs moved quickly to offer spot Bitcoin ETFs to their wealth management clients. JP Morgan could no longer afford to ignore the demand and competition. And so came the inevitable announcement in May that the bank would allow clients to buy spot Bitcoin ETFs through its JP Morgan self-directed investment platform, with holdings reflected on client statements. And this offering was a defensive play, but JP Morgan followed up with an offensive earlier this month by permitting its trading and wealth management clients globally to use shares of spot Bitcoin ETFs as collateral for loans. The program is set to begin with BlackRock's IBIT, with other ETFs expected to be added over time. As part of this policy, JP Morgan will formally integrate crypto ETF holdings into clients' net worth and liquidity assessments when determining loan eligibility and terms, a practice that was previously handled on a limited and case-by-case basis. As far as we can tell, JP Morgan is the first bank to make such an offering. Goldman Sachs, which is rather more progressive when it comes to crypto, has been enabling clients to use BTC as collateral for loans since 2022, but we couldn't find an equivalent offering for BTC ETF shares. Now, all of this is a very low-risk play for JP Morgan because it can offer clients all the Bitcoin exposure they want without ever having to custody the underlying asset. Not to mention the fact that by channeling exposure to crypto through centralized regulated wrappers, ETFs strip crypto of all the properties that might otherwise pose a challenge to TradFi institutions like JP Morgan. With no trace of decentralization, censorship resistance, or peer-to-peer functionality, crypto ETFs are just another instrument within the traditional financial system. So, by entering the ETF ring, JP Morgan can stave off client and asset attrition to competitors and, God forbid, crypto-native platforms, all the while focusing on its crypto endgame, which is far more ambitious. Since at least 2017, JP Morgan had been building proprietary, permissioned, and compliant enterprise blockchain infrastructure with the goal of supplanting public permissionless networks as the primary rails for the future of institutional finance, tokenization, and significant economic activity. And this provides more than enough incentive for Dimon to spend the rest of his career criticizing crypto, as every disparaging remark he makes is an implicit advertisement for Connexus by JP Morgan, the bank's dedicated blockchain and digital assets division, Established in 2020 as Onyx and rebranded in late 2023, Kinexys is now a core part of JP Morgan's business. It has already processed over $1.5 trillion in notional transaction volume, with current daily volumes exceeding $2 billion, which is not far off from Ethereum on a bad day. Speaking of which, Kinexys happens to be based on Ethereum, but it is a permissioned ecosystem, making it a walled garden accessible only to vetted institutional clients. The core components of this ecosystem include the payments rail, formerly known as JPM Coin. I guess that sounded too crypto adjacent because it has now been rebranded to Kinexys Digital Payments. It's a system for tokenizing deposits made in US dollars and euros that enables institutional clients to conduct instant, programmable payments around the clock between JP Morgan accounts worldwide. Its primary use case is for corporate treasury efficiencies, such as optimizing intracompany liquidity, accelerating B2B settlements, and automating complex payment flows. And then there is Kinexys Digital Assets, the platform for the tokenization of real-world assets. It provides solutions for digital financing, enabling the execution and settlement of repo transactions in minutes rather than days, and for tokenized collateral, allowing clients to tokenize assets like money market fund shares and use them as collateral for intraday liquidity with near-instant settlement. It also offers a digital debt service, an end-to-end ecosystem for the issuance, trading, and lifecycle management of digital bonds, automating processes like coupon payments through smart contracts. And lastly, there is Kinexys Labs, the R&D arm exploring Web3 solutions for enterprise use, including on-chain privacy, digital identity, and deepen networks. And if much of this sounds like JP Morgan is trying to usurp DeFi, then you're on the right track. However, it's not entirely black and white because the bank's general antagonism towards crypto hasn't prevented Kinexys from collaborating with actual DeFi projects. And this is probably because crypto is where the real innovation happens, rather than in some bank's walled garden. Most notably, Kinexys collaborated with Ondo Finance and Chainlink for a proof of concept where JP Morgan used Kinexys Digital Payments as the payment leg to settle a transaction involving Ondo's tokenized US Treasury fund on the public Ondo chain testnet. So, we can see a clear intent to connect the world institutional finance with the actually existing DeFi ecosystem. And this is a little bit more like what BlackRock has been doing with Biddle, its tokenized fund on Ethereum. But the key distinction here is that while BlackRock is wholeheartedly building on crypto's existing public infrastructure, JP Morgan is experimenting with private on- and off-ramps to this infrastructure that it will own and control. And here we can see JP Morgan's true crypto endgame. Kinexys is a competitor to public blockchains like Bitcoin and Ethereum. With its permissioned access, institutional-only clients, a focus on tokenization of TradFi assets, and embedded compliance, it's the antithesis of the open, decentralized, censorship-resistant ethos of crypto networks, flawed as they may be. JP Morgan has dissected the technological benefits of blockchain and systematically rebuilt them within a proprietary network that's aligned with the interests of TradFi. The bank's vision for the future of finance aligns perfectly with that imagined by the World Economic Forum and the Bank of International Settlements, which see a world of tokenized assets built on permissioned, trusted, heavily regulated, and generally private infrastructure. The game is to capture the high-value layer of assets and settlements while leaving the meme coin casino to the public markets. But if JP Morgan wants to accomplish this, then it will need to do something about stablecoins because they represent a vast and growing parallel payment system that exists entirely outside of the traditional banking rails, which are, the whole point of banks. As a direct threat to banks' core business model, stablecoins could cause banks to hemorrhage deposits, lose transaction fee revenue, and ultimately weaken client relationships. The threat of disintermediation by Tether and Circle must have spooked half of Wall Street because JP Morgan is now in cahoots with Bank of America, Citigroup, and Wells Fargo to discuss the launch of a jointly operated stablecoin. The plan reportedly involves leveraging existing bank-owned payment infrastructure, such as the clearinghouse and early warning services, to build and distribute the new stablecoin. And this collaborative approach is reminiscent of the US banking industry's creation of Zelle as a joint response to the competitive threat from fintech payment apps like Venmo. The joint stablecoin initiative is a cartel-like maneuver to marginalize crypto-native stablecoins by creating a single, interoperable, and fully regulated dollar with all the network effects of the US banking system behind it. For JP Morgan, this would complement Connexus's targeting of the institutional layer with a new digital dollar operating at the commercial and retail layer. Taken all together, JP Morgan and its peers are planning a complete parallel digital financial system controlled entirely by the incumbent banking powers. And when you put it like that, what is a Wall Street stablecoin but a privatized central bank digital currency, or CBDC? The Trump administration has made its opposition to CBDCs very clear, but mostly on the grounds that it shouldn't be the government issuing one. But will the government object if it is private interests doing the dirty work instead? I wouldn't count on it. And lo and behold, just as we began shooting this video, we learned that JP Morgan has filed a trademark for a, quote, digital asset platform enabling trading, exchange, payments, and issuance. The name of this platform is JPMD, and although we don't know what the D stands for, our money is on dollar. And this would strongly suggest that JP Morgan is planning its own stablecoin launch, so something that could be interpreted in many different ways. Does it mean that the joint effort with the other Wall Street megabanks collapsed, leaving it up to Jamie Dimon and co. to pick up the slack and claim credit? Or perhaps the banks each decided to repackage their joint stablecoin in different wrappers for their respective audiences, and that would suggest after JPMD we might see, for example, BOAD for Bank of America. Then again, it's always possible that JPM is reserving the JPMD trademark just to be on the safe side. We can't say for sure, but for now, it sure looks like Jamie Dimon approved stablecoin is in the pipeline. On the one hand, this could be America's first bank-owned crypto on-ramp, which sounds very bullish for crypto prices. On the other hand, the top signal energy is quite strong with this one. At any rate, we will be looking forward to what acrobats Dimon will perform to promote his new cryptocurrency without losing face. We'll have to wait and see, but for the moment you can learn more about the future of stablecoins by watching our latest video on that right over here. For today, the verdict is that JP Morgan's crypto posturing and likely stablecoin issuance is bullish for prices in the short to medium term because it is a significant new channel for TradFi dollars to keep bidding BTC up to the high heavens. But in the all-important long term, if JP Morgan's schemes are successful, they could very well be bearish for crypto. They represent co-option and domestication of a revolutionary technology by the powers that it was supposed to disrupt. You could argue that that's a ship that's already sailed some time ago, but if Connexus and the mooted Wall Street stablecoin see real adoption, then BTC could actually start to look a lot more like a pet rock than a new monetary system. And you can bet Jamie Dimon would have plenty to say about that. Now, if you guys want to watch that stablecoin video I talked about, then you can do that right over here. And if you're not subscribed to the channel yet, you can do that right over here. That's me for now. Thank you guys very much for watching, and I'll see you again soon.